Yeah, yeah. Good afternoon, friends. I, on behalf of ICSI, welcome our speakers of the day, CS Vinod Kothari ji and CS Pradeep Ramkrishnan ji. And I also welcome all my fellow friends who have joined the webinar. Friends, Team ICSI and I being the chairman of practicing of ICSI under the guidance of our president, CS Devendra Deshpande ji, VP Manish Gupta ji, and my colleague in the committee, Mr. B. Narasimhan and CS Sanjit Pandey ji, we are planning a lot of webinars to update our members on a regular basis on the various topics based on the recent amendments, hot topics of the day, capacity building in new area where our member needs. We are also planning to do webinar for the capacity building of for the area of optional audit, RPT audit, NBFC compliances audit, and RPT audit, and like this. Friends, recently the MCA and SEBI has come with a lot of amendments to take the corporates at global standards, more robust by syncing the same with best global practices and ease of doing business as well. These newly amendments by the to have a detailed twist on the refined amendments in Companies Act as well as LODR topic were proposed to be discussed today so that our members have a better dealing with. We have requested and kindly consented by CS Vinod Kothari ji, a practicing company secretary, to give his views. CS Kothari ji is in practice since last 3 decades. No knowledge him. So I not to read his profile. We have also requested and by Pradeep Ramkrishnan from the reports and expected from reports.
संदीप जी, आपकी आवाज एकदम हार्डली आ रही है.
Level for ICSI, and always we are getting support from him. He is associated with SEBI since last 2 decades. In today's webinar, both the speakers may give their views in approximately 30-40 minutes. Then we will start with question and answer session, sir. Members may raise their questions through the link event also. First, I would like to request CS Pradeep Ramakrishnan ji to please express his views on the topic LODR amendments. And I now hand over to session to you, sir. Pradeep Ramakrishnan, sir, please.
Thanks, Mr. Kejriwal. Thanks to Alka also. I like to welcome Mr. Vinod Kothari, a person whom I regard very highly also. Morning, sir, and welcome to all the participants. I think so. Whenever there's going to be any webinar, LODR is always a material, right? So there is something which always keeps happening. The other day we were also joking that the LODR is probably one regulation which has got more footnotes than the main body of the regulation itself. So it is so much surgery has gone to LODR that, like probably we may even need to bring a new LODR so that, one need not go down to, check what is happening, what happened earlier. So many footnotes. So I was like, we just printed one and then probably it has got, sort of extinct in just a couple of months. So, but that's how dynamic I think the market is, and there is a lot of things to, which we have to, probably take into account, which is why it's something which we also don't want to do. It's not like every time there is going to be a board meeting, we don't want to have LODR as one of the things. But there are so many things that happen, and a lot of things which I probably like to, go down to probably gist of why things happen. How things have happened, And what are the things that have happened? I think everyone actually knows, and you may be able to even tell me much better. So probably I would like to go into how and sorry, the why they happened. That is the reason. Probably from a regulator, you need to have a different perspective, and probably I would like to say that. And so I hope you will be able to bear with me as far as that is concerned. So what I'll do is that I'm just going to share one small PPT and. Yeah. Okay. So the first thing I would like to talk about today is our independent directors' independence. So this is something that is, if you look at the Kota Committee report in June 17, right from them, there has always been a clamor around whether we can do anything about independence. So after all these amendments, after almost 20 odd years, we know for a fact, and we may even come out with anything later in the future. But we all know that the independence aspect is something that has to come from within. And you can never legislate independence. We can say that, okay, we can mention some things about conflict of interest, which will not be considered as independence, and we may have different thresholds. If you have 10,000, if you have 10 lakhs, if you have 10 crore, so those are the thresholds which we may be able to bring. However, but if you look at independence, how to legislate independence is something which no regulator on planet Earth will be able to do. So this will be only something which is going to be interpretational. People are going to talk to each other and say that, okay, I feel that this person is independent and this person is not independent. And what is independent in one scenario may not be independent in another because of the facts and circumstances of that particular case and the specifics of and mechanics of that particular situation. So recently we brought in some changes which came in as far as this is concerned. On the background of that, I would like to tell you the first thing that happened was there was one case of man-person beverages. I think the SEBI warning is also there on the website. So this was a case where two things. One was the father and son were the chairman and managing director. So this is related to two slides, but I will tell it here itself. So the father and the son were being appointed as managing director and another executive director. And both their appointments got rejected by the shareholders. So what the board did was the very next day after they got rejected, they again appointed them as directors. And they got a shot in the arm in the form of the COVID pandemic. They didn't conduct an AGM for the next 1 year. So these people who were rejected by the shareholders, they continued to be the MD and director on this company for a period of almost 1 year. When after despite multiple correspondences from SEBI, there was inaction on their part, and finally, we had to push them to do it. The second background of this is that I remember the Tata episodes that happened around 5-6 years back. So there was one thought process from one of the directors that one of the companies rather, when some of the commentators also at that point in time had written in the media about the fact that if a person is appointed by a special resolution, that person cannot be removed through an ordinary resolution. That is also something which is some sort of lacuna which was there. So we also requested MCA, and then Section 116 of the Companies Act also got amended. So then after a point in time, there has been some discussion around this as to whether an auditor, an independent director can be specifically, because as far as mandating every director as special resolution is a little too onerous on companies. So why, when the whole aura around an independent director, discussions around independent directors are so much, so we need to ensure that the independent directors are also appointed through only a special resolution, because in many cases, when the independence comes to question, at least then you have this defense saying that, okay, the 75% of the shareholders have sort of approved the appointment, so they consider that person independent. So appointment, reappointment, and removal should be only through special resolution. The second one on NRC composition, which is also I think, and there are two views to this, because many people feel the NRC should also be populated by a lot more people from the company, because the independent directors may perhaps not be, the independent directors perhaps cannot comment on having more independent directors may not yield the desired results, because they may not know much about the company, the scale, and other cases. And sometimes, for example, government companies, it's a non-starter because the scales are already fixed with the government. So what does NRC do in that case? So, however, when there were some discussions made with the industry, they felt that there is no problem as far as this is concerned, and some of them even felt the other way. The other side of the argument is that a person when the independent person is taking a judgment in issues such as scale, the payment to the directors, etc., will assume that sort of significance because it comes from an independent person. So, for example, managerial remuneration is something which is always, under a scanner, is always under a spotlight. So, if it is done by independent directors, then there is independence also. Secondly, the other issue also about the NRC, because the NRC also selects KMPs, it selects directors, etc. So there also can be an increased element, perhaps, if I can put it that way, of fairness as far as selection of these people is concerned, because ultimately people who are going to sit there are going to be independent. If 2/3 are independent, then there is so much independence to that particular decision taken. So it comes with less strings attached, is the other thought process. So the capabilities are something, of course, which the NRC has has to put in place. If you look at the LODR principles, a lot of things about how a company should behave is there. So if you see, there's a very interesting and important line towards the end of the principles. It says that whenever there's a conflict between principles and rules, the principles shall prevail. So in which case that I have to rather sit in judgment of a particular situation, and if a rule does not provide for it, then I should sort of look into the facts and circumstances of the case and take a decision in the spirit of the principles. That is the reason why the principles are being given. You have disclosures, you have board responsibility, etc. Also, so many things are there. However, there is a need for increasing shareholder awareness. Recently, you must have seen the last 4 or 5 years, if I can perhaps put my finger to that, there has been an increasing role of shareholders in rejections of multiple things, even appointments of directors, taking a very new plan, for example, acquisitions and other things, and repayment of loan, waiving off of loan. So many things are there where the shareholders have sort of come to the party and said that, yeah, we matter. In this same breath, the other set of people who also assumed importance is the proxy advisors. So, which is why the increasing share, because I remember 10 years back, there used to be a lot of discussion. Okay, you're bringing so many things. What is it? What is the impact that I have on the shareholder? And what is the shareholder doing with all these powers that you have brought? Like, for example, a mutual fund. So, does a mutual fund vote? So, of course, a lot of these institutional shareholders do vote. And the efforts are on from SEBI to make even retail shareholders whole, because I remember 4 years back when we did some statistics. I mean, of course, the figure is somewhere near only. So it was around 0.8% of the retail shareholders who vote, which is like a very pathetic number when it comes to the amount of the amount of effort that SEBI has taken in sort of giving them all these powers, etc., which is not something which I would sort of approve of, because when you have given so many powers and so much, you have to make use of it. And SEBI would be very happy if those things, happen. And it's like that is how the things are there on the right track. So this is something which as I told you, after that particular incident of one-person beverages. So this was done where we had said that in case there should be a prior approval, again, you have to go to the shareholders only. You can't just go to the board and get the whole thing ratified. And again, you have to take the explanation from the board and NRC as to why you're presenting the same person again. Because obviously I as a shareholder would like to know. I have already rejected this person's appointment. What is it that you want to see in me, that see in this person, that you want me to approve the same person again to the post? The BRSR, I'm sure I have personally also, the ICSC has been kind enough to giving me opportunities to speak about BRSR. So BRSR is something which you can, keep talking till the cows come home. The whole ESG concept is something which we all have to imbibe in our everyday lives. What are you doing for the society? What are you doing for the environment? The Companies Act very rightly recognizes this under 1662 when it says that directors' responsibility also extends to the environment. So it's not that, because there was one point in time when we all knew that, it was just like your Adam Smith's Wealth of Nations, maximization of profits, maximization of wealth was the reason why companies were being formed. And shareholders, as long as they make money out of that by company doing, like, for example, a tobacco company an oil company, for example, these things are, like you don't see tobacco companies losing money. You don't see oil companies losing money because, for example, oil is something which is an everyday thing you need, and the number of people using oil are only increasing by the day. The quantity of oil being used is only increasing by the day. And tobacco, for example, there is no one, you can't stop a person from smoking. It is the person's will and voluntary the person. The number of smokers, that way newer smokers also keep increasing. The people who are kicking the habit, and when you're looking at the newer smokers, and particularly the younger age bracket, for example, the government came with this regulations on this vaping, electronic e-cigarettes, for example. But so when you look at all those things, how much are you doing to society? So we have brought in a metric. The idea was earlier the BRR that was there. People were filling, and it was a good attempt that SEBI made to bring in sustainability reporting. It was the first to make that inroad as far as Indian disclosures are concerned, and also one of the earliest regulators around the world to do. Now, our BRSR is probably very comprehensive. It's one of the things that can be emulated around the world. So the biggest difference is the quantifiable metrics, as you can see on the slide. Because earlier there was a lot of things where perhaps, if I can use the word, it's a little too specious, in as much that you disclose a lot of paragraphs and paragraphs of how the company is doing this and doing that. But now you tell me what exactly you are doing. How many women have you appointed? Okay, how many specially abled people are there on your company? So those things can be measured only when you are going to give numbers, right? So that is how this whole new BRSR has come. We worked for a long period of time on this along with MCA. We spoke to different people, Niti Aayog and other things, and this has come out. And this will be the first year when it is a mandatory report. So, and apart from the voluntary disclosures, we also have got certain leadership indicators. Indicators. Leadership indicators are like something which you can sort of say that we are also doing this. So there are many companies which take pride in being ahead of the curve and probably being someone who's going to cause a demonstration effect. And companies which that's a good thing. And that's how it evolves. Like before SEBI brought in the quarterly reporting, there were some companies who were actually doing it. Like, so you don't need the regulator to tell you what to do. You can always do something. You can always be an industry leader in doing certain things. So many companies who are really very environment conscious. So I have seen their BRSR reports, BRSRs personally. So they have, in fact, they have already volunteered. Many of them have already adopted the BRSRs. And when I was looking there at the BRRs also, I found that many of them have, they've really done a lot, and that's why they are also happy and proud to showcase what they have done for the society and the environment. So this will be a big, thing. So this is something which is going to be the thing to be talked about for years to come, because many countries have got ambitious targets as far as moving to zero, net zero. India has a 2070 target. Countries like Britain have a 2030 target. So which is very ambitious. It means that I'm going to emit less than what I am, sort of saving. So that is a very important thing. How much am I going to create? So, and a lot of European countries have sort of being a little ahead, particularly the Nordic countries, Denmark, Norway and all that. So they have been a little ahead of the company. They're always sort of carbon positive as opposed to other countries. So it all differs. Like many countries have sort of, resolved, they have sort of degenerated to pointing fingers that you are polluting more and I am polluting less. So let me pollute. And so over a period of time, we have to look at how COVID has affected us. It happened in one small part of the world, and it has hit the entire, it has hit the entire world. So it's not about who is polluting where. Air is common around the world, and it's not that war in one country is affecting everyone, for example. So that's how it is. It's an intertwined world, and we have to be very conscious of it. And this is a very small thing because SEBI's over extends to only sort of like for 5,000 odd companies, listed companies. When there are lakhs of companies in the country, but this is a very small start, and these companies are big. They have a huge role to play in the economy, and they can be sort of people who can bring this as a demonstration effect. Okay, this is the structure of the BRSR. I think this is something which you know. The other one, okay, risk management committee is also closely connected to your COVID thing, which I would like to say. Until the COVID thing came to us, we didn't even know that thing of this gamut would hit us. and so, okay, what is a plan B? Okay, so then we found that we didn't even have a plan A in place. Forget a plan B. So it's everyone. Then it's sort of it is, and SEBI came out with some advisory, and the advisory was like, okay, how you can disclose, what is the maximum things what are things that you can disclose, what you can bring to the table. So that advisory came out, I think, in July 20, and we thought of sort of bringing. That's something I think probably this will take some time, but risk management is something, particularly cyber security. Recently there is, you must have heard, I think probably people have reading the international media. Yesterday I found a study which said that many Indian companies have also been hit by cyber frauds. I mean, it's not that Indian companies are not hit, but there are companies, big companies in the US also and Europe, which have been hit by frauds. So much so that their entire operations have been paralyzed. One company which was dispensing petrol found that one fine day the petrol pumps were not working because the software was hacked, and they had to pay some Russian hackers, the ransom of close to so many millions. So, as far as if I was a director on a company, then I would be a lot more concerned about what risk management that I'm doing. So, risk management just you sort of assume situations, and you also look at the like, for example, the pandemic taught us that it showed us that we can still work if you are like sort of being within four walls. We then work from home became a huge issue, and we found that at a point in time man is a very adaptable animal. The man is perhaps the most adaptable animal. So the man can adapt. So how you can adapt and what is probably a blueprint for adapting is something what your risk management measures should be there. The risk management committee should see, and that is the reason why we increased it to 1,000 liabilities from 500. So the policy should be, they should frame the policy, implement it, and also see its review the same. Now the CIRP has assumed importance ever since the bankruptcy code has come into play. However, the listed companies are not disclosing certain issues. The shareholders are not in the know because only a few creditors decide things, and then it is filed. So what is the impact? And a few people can perhaps also make use of this information in a wrong way, So that is the reason why this has been brought, that the resolution plan disclosures should be, should be made as soon as possible. And in case there are delisting plans, they also have to be disclosed. Related party transactions, I am not throwing much light. Of course, there is something Mr. Kothari has said he will throw light on, and there is questions on RPT also he will be handling. So I am not going to talk about RPT as far as today evening is concerned, and I'm not escaping. But I think it's good that he talks. I think I've seen his articles on RPT, and they are pretty strong, and you should actually listen to him as far as RPT is concerned. So these are other things which actually have happened over the past 1.5 years. The one thing which we try to do in September 20 is. We try to sort of reduce, the timelines and try to, bring in forms together so that companies are not burdened. Our want is certainly not to disturb too many companies, in as much that there is no need for repetition of disclosures, etc., which we are trying to harmonize. One thing which I would like to tell all the participants here is that two things. Okay, one is of course your what do you call in case you have any suggestions at any point in time, please send it to us. We are a continuously evolving regulator. I would like to tell you that we are not an ivory tower regulator. We are not sitting in a place, and it's not that we don't listen to you. Most of the amendments that have come forth over the past few years in the LODR, etc., have been only after listening to you and taking your suggestions, from different stakeholders. It need not be from the companies alone. It can be from various stakeholders. So we have actually taken that into account. So there are, I just saw that there were some questions tagged by Ms. Alka. So I will just look at the ones which I can perhaps answer other than the RPT ones. And then probably I will call it a day. Just a minute. CSR, okay, it doesn't come under SEBI purview CSR form, so I'll not be able to get into that. So there are some things. Okay, here it is. Okay, there are 3 things here on BRSR. Okay, so the first question is that in what ways BRSR is different from BRR and how it will help in better reporting of ESG entities. So it's a good question, but if you look at BRSR, as I said, it is a huge improvement over the BRR in as much that we have tweaked it so much. There's a huge, sea change when you compare to both these things. And the main thing is the quantifiable metrics. See, if I'm going to say that I'm polluting less, okay, how are you polluting less? Or if even someone has to be, someone has to point fingers and say that you're polluting more, and you're not doing enough for the society, or you're doing more for the society, then all these things will be able to sort of come to a conclusion or probably accept or reject the argument or the notion only when you're going to have statistics. So this particular thing, so I know that it's going to take time for companies to prepare, which is why I request all the company secretaries, particularly the practicing company secretaries also who are there, they can also render their services as far as this is concerned, because companies need to ensure that they keep in mind a lot of things while preparing the BRSR. I'll tell you why. See, this is something which is going to affect all of us. It is affecting all of us. Have you seen in the past 2 years the amount of electric vehicles that have been sold have gone up? Today, the waiting period for a Tata Nexon EV is more than a Tata Nexon petrol. Okay, which means that people are willing to pay more. And electric vehicles, you all know, are costly, which is a very good thing. Which means that people are being conscious. Not that if I buy an electric vehicle, I'm going to save something, because what goes inside the electric vehicle also has, all your cobalt and other things, lithium and other things are also, they come from the ground only. But at least to that extent, when I compare these two, I know that I'm paying more, but I'm willing to do that for the environment. So that consciousness has come is a good thing. And it is almost, it's an inevitable thing, because the amount of industrialization that has happened over the past 100 years is the previous years, actually there is no parallel. And that has led to so much pollution and other things which we need to, because we don't care, we just get into a car, we just get into a scooter or something, we come to office and we go back. So that is something which is which we have to consider. So as far as I am concerned, and as far as the regulator is concerned, there's a huge difference as far as these two are concerned. And since the quantifiable metrics are there, and for the first time, we have also brought in a very comprehensive guidance note. So that will, I believe, help in better reporting of the ESG factors of listed entities. And how improved ESG reporting will attract more capital investments? Very good question. You will be surprised to know, when we were doing this whole BRSR report, right, when we were just preparing the BRSR initial report on the basis of which the BRSR came about, we discussed with certain export companies, MSMEs. I'm not talking about big ones, I'm talking about MSMEs. You will be surprised to note that they follow ES concept. Leave the G part. G part is all anyway codified. The E and S part of ESG much more strongly and in a lot stringent way than some big companies also. You know why? For example, if there is a huge an order from a very big company, that company comes to your plant. Okay, those direct there are inspectors from that big company which is give you an order. They come and check. For example, Nike is manufacturing shoes. In the mid-20, in the early noughties and all that, there was a huge protest against Nike because they said that they are employing child labor. Okay, and they are they are using small sweatshops where the conditions are very inhuman for workers. So what happens is that this huge PR exercise is important, and it hits the companies also very badly. So companies which outsource manufacturing to countries like India, for example, even LPO, BPOs and all those things, we earn services, for example, contributes to 52% of our GDP, and it comes through a lot of these things come through, foreign companies giving business. So we earn a lot of foreign exchange also. But this is possible. So, like for example, recently in the Foxconn plant in Sri Perumbudur, it was closed for a long time because of social factors. It was because of social factors, because of the S factor being against. That is why companies send their inspectors to check, and to after the things got ameliorated, you got the order. So ultimately, ESG translates to better commerce, no doubt about it. And over a period of time, see, why did the plant, the copper smelting plant in Tuticorin close? right? If you keep asking questions, there are so many factors. So the E and S concepts, the portion of the ESG is very important, and they ultimately it helps in better commerce. The few of the examples that I gave you, they help in the company continuing to run the business. Okay, that is why it is important. Okay, the other question is the key challenges in filing of BRSR. Okay, the key challenge lies in preparing it, not filing. Okay, the first thing is you have to be true. What do you want to report? Because if you are going to use the BRSR as a reporting tool rather than a learning tool, then the report will be different. If you look at the BRSR as a reporting tool, okay, this is a checklist. Yes, yes, no, yes, no, submit. So it's only going to be a reporting tool. Whereas if you're going to use it as a tool for you to imbibe the whole ethics concept, the thing is to how I can contribute better. Because today, after a point in time, see today, for example, you take ITC, if I can give an example, they have diversified into non-tobacco products. Why? In UK, there was a huge, a lot of discussions over Philip Morris taking over a pharmaceutical company because that's a cigarette company. So these things, and finally, of course, they managed to get in Carlyle's vote and then do it. But the fact is that now companies are also becoming increasingly a lot more conscious about what they are marketing, what they are doing, because one small incident, one wrong incident, gives a huge dent in commerce. So the preparation of BRSR also assumes that much importance. So, over a period of time, BRSRs also will start being scrutinized in the newspapers, in the media, as to what have you reported, and then there will be fact finding also, right? So that is why, as far as BRSR is concerned, first the difficulty will be to collect information, be true to it, and the challenge will be to report. That is the second part. The main part is how you are going to look at it as a reference guide. If you are going to look at it as a reference guide for the company's own, then of course you will have a very true BRSR. That's the idea. Alka has sent a few questions on WhatsApp. Let me just MSME, I don't know, the BRSR thing, whether for annual report 21, 22, I think these things are there in the circular. See, I don't want to answer questions on which are like very evident. I would like to answer questions where there is some insight that is required, because how many directors should be independent. I think all these things are very clearly given in the LODR. I think, if you are falling in the top 1,000 and then you have moved to the top 2,000, I think then there is a specific residual clause which is given in the LODR. Please check that particular clause. It says as to how long you will have to continue to comply with that, with the regulation. Okay, I think then other things are on RPT, which I think Mr. Kothari has kindly consented to answer. So I'm not touching on RPT because you don't need the same two people talking on the same topic, and that is why. So I think so. I'll take leave here. So I thank you all for a very patient listening, and I thank Mr. Kothari to also for having started after me, because I can always hide under what he's going to explain, because he's a wealth of knowledge, and it's good of ICSI to have him today evening also. So thanks to Mr. Kejriwal and thanks to Ms. Alka. I take leave here. Thanks a lot and have a wonderful evening. Thank you.
Sandeepji, should I take over straight away?
Yeah. You can take over, sir. Thank you so much.
Thanks very much. So before Pradeep sir disappears, I must first of all compliment him for a wonderful presentation. I must also reaffirm the point that he mentioned. As regards SEBI, that's the entity that listens. SEBI is always prepared to listen. This is something that we've also experienced, and I completely vouch the statement that he made. Particularly, he is an individual. We know he's a member of the institute, he's out there for a professional brother. But when it comes to accessibility, he's sort of accessible any point of time. Within seconds, you get his response. So thank you very much, sir, for being prepared to listen to professionals. And I completely see SEBI is extremely interactive and extremely receptive as a body. It's certainly not an ivory tower. We know regulators who have ivory towers as well, but SEBI is surely not one. I would also start with some of the points that he made, and he made wonderful, pertinent observations about ESG. And just 1 minute before, I'm sure he has meetings to catch up, so I'll just take 1 minute, which is sure. sort of an additional observation to the one that he made. People look at BRSR as a report. BRSR is not another format. It's not another report. BRSR is business model. You need to understand that companies have to align their business models to fall in line with environmental, social, and governance considerations. It's a mode of life, mode of business, and therefore it's all about business model. If the business model is aligned towards social and environmental responsibilities, you'll find no issues in preparing a decent BRSR report. But if you've taken this as a sort of reporting formality, so that end of the year we wake up and see what answers we give to questions, you'll definitely not be able to give the true picture of your environmental and social image. And he made a point about the acceptability from a commercial standpoint of companies which have excellent ESG concentric models. I must also add that when it comes to investors today, all global investors, be it FDI investors or even ECB lenders, all of them today look at ESG rating of the entity as well. They not only look at how profitable you are, they not only look at what is your market cap, they also look at what is your social performance. So ESG is now a social performance metric. It's a social performance report. Like your annual report is a report on your profitability and net worth and market cap and what all, ESG is a report card on what activities are you doing from a social angle. So therefore, ESG is increasingly getting relevant. And I would say today, almost anywhere in the world, ESG considerations have become so very central. Particularly, as you rightly mentioned, during the COVID crisis became even more focused. But today, it's a central theme of business all over the world. And therefore, don't wait for 22-23 to end when it comes to time for you to prepare the BRSR report. Actions have to be done all through the year because there's quite a lot of action. For example, identifying value chain partners. What exactly will be the definition of value chain partners? Who all are value chain partners? Your vendors, your suppliers, your raw material suppliers, your service partners, your distributors. You need to identify value chain partners. You need to identify what are the requirements about the value chain partners as well. So there's a lot of work to be done. The 9 principles have tremendous amount of work. And I think unless companies start working on a proper BRSR framework, it's more of a framework than a report, through the FY 22-23, when it comes to the end of 22-23, you'll find it really difficult to prepare a nice BRSR report. Pradeep sir, thank you very much. I know your meetings to catch up, so kindly feel free to.
Thank you so much. I'm sorry I'm not able to attend your presentation. Sorry. Thank you so much and thank you.
Thanks. Participants, it's indeed a pleasure to be here in midst of all of you. And Sandeep ji, thank you for giving me the opportunity. I assume that there are a lot of professionals from across the country might have joined today. Unfortunately, I'm not able to see you all. I would, however, love to interact with all of you. If you have questions, please feel free to post in the chat. Several questions have already been posted by Sandeep ji by way of communications he has been sending since yesterday. Let me just quickly give a picture of what all we're going to do over the next roughly about 1 hour, and then I look forward to interacting with all of you. A will very quickly zoom past some of the changes in corporate laws, primarily the Companies Act, and then we focus on changes in LODR. Pradeep ji has discussed ESG changes, BRSR changes. He's discussed independent directors. He's discussed some of the other LODR changes too. I will therefore focus on the changes pertaining to RPTs. Sandeep ji continues to tell me that there is a separate dedicated session on RPTs. So please do make sure that you attend that one as well. Today we'll take a quick view of some RPT points. The LODR changes about RPTs. But before we do that, I'll take you through some of the changes in corporate laws. It goes without saying that corporate governance today is like a moving train. It's a train which is constantly on the move. Business world is even a faster moving train. That's a super fast train. Businesses are moving even at super fast speed. Corporate governance, that is the principles which regulate companies, are also on the move. And therefore, if you are off the train and then you want to catch it up again, you'll find it tremendously difficult to catch it. Please understand, you got down a moving train and then you want to sort of run and catch it. You'll find it impossible to do that. Therefore, it's quite important for all professionals to stay alert. And I think each such change brings a tremendous opportunity for professionals. I'm not referring to the form filing or form filling opportunities. I'm referring to opportunities in terms of underlying philosophy. Like you just heard Mr. Pradeep Ramakrishnan about the philosophy of BRSR. As professionals, we will be expected to contribute on what exactly is the regulator wanting to learn, or what exactly is the regulator wanting to know about the ESG activities. So it's not all about preparing a form. It's the underlying principles, underlying philosophy, underlying jurisprudence that goes behind a change. So these changes have brought about a tremendous opportunity for all the professionals. And I'm sure all friends who are joining today from across the country would support me in saying that over the last couple of years, I think all professionals, despite whatever disruptions might have been there during the pandemic, at least the practicing professionals, I think the businesses were actually, at least I think I can say that the businesses actually flourished rather than suffered any setback. Let me straight turn to the Companies Act changes, and then we talk about the LODR changes too. Then in terms of the Companies Act, I'm going to briefly talk about the changes in the CSR2 or the requirement of CSR2. This is an area of concern. Sandeep ji has already shared some of the questions about CSR2. Now, just reflect on the way the government has moved on CSR provisions. Originally enacted as a comply or explain principle. The government wouldn't penalize you. The government expects you to spend. But if you don't spend, just give an explanation. It was a comply or explain provision. Then the amendments made it comply or pay penalty. And now the next step in ensuring compliance with CSR is that there is a sort of automated tool which ensures compliance with CSR. You probably would still be filing a report with your board report, but the CSR2 is a sort of artificial intelligence at work, whereby the government would detect the obligation of the company to spend and the fact whether the company actually has spent by way of a virtual or virtually artificial intelligence at work. Like the income tax return today is mostly automated. As you fill it up, it automatically computes your taxable income and automatically computes your tax liability. Similarly, when it comes to CSR, as you fill in the parameters, the form would compute what's your CSR obligation, and therefore the MCA through the CSR2 form is keeping an automated watch on the extent of compliance by companies. As you're all aware, and Sandeep ji has been posting this information regularly, that the last date for filing the form for financial year 2021 has been put as 30th June 2022 now. In any case, for financial year 21-22, it would be filed as an addendum to the AOC 4, which is post the AGM. And some of the concerns about CSR2, number one, that the form inherently has some issues still. Some of the issues are that when you look at the threshold of CSR, threshold for applicability of CSR is based on last year's profits. As everyone knows, CSR is based on what? Turnover, net worth, and profit. The profit is which profit? The profit is profit for the last year. But the spending obligation is not last year's profit. Spending obligation is average of profits over the last 3 years. So assuming when you had a profit in last year, but the average profit for last 3 years is a negative number, you'd probably say, I was covered by CSR obligations, but there is nothing for me to spend because the average of profits for last 3 years is a negative number. You cannot be spending on CSR if average profits for last 3 years turns out to be negative. However, the form seems to be working under an algorithm that even though the average of last 3 years profits is negative, it still computes an obligation for you to spend. That's, I would say, the underlying, every form has an underlying algorithm. The algorithm would have been designed by somebody who is not a company law person. It's obviously an IT person. And therefore, the one who supplied domain expertise to the maker of the form would have probably done some goof up there. Now, these issues are there in the form. People have probably raised these issues to the MCA. Good thing about CSR2 form is that you can attach an optional attachment and you can give your computation. Even though the form says that your obligation to spend is whatever, you can then attach and say that as per me, the computation works out this way because I'm looking at average of profits and therefore I don't have anything to spend. Yet another mismatch or sort of disconnect between the form and the view taken by MCA is the possibility of setting off excess spending in earlier years. I'm sure you all recall that when the changes came in CSR rules in January 2021, one of the appreciable changes was that if you've done excess spending, you've spent more than what you were required to spend, you can set off the excess spending against your CSR liability. The MCA came with a view, and that was probably the view of ICCI as well. That wasn't our view. We have a different view on that. But MCA view and ICCI view was that you can set off the excess spent by you only if the excess spending is after the date of change, which would mean only if the excess spending is from the month of January 2021 onwards. Looking at the form, it appears that even if the excess spending was in 1920, it may still be set off. This is what my colleagues who have gone through the form tell me, that the form seems to imply that even if there are excess spendings in FY 1920, you can set it off. So maybe that's a disconnect between the MCA's own view and the form. Auto calculation of some figures, there seems to be no rounding off or approximation possible. We talked about the negative profits. Then question that people have raised is, when I fill up the net worth, we fill up the total, the turnover and the net profit. If you're filling it for FY 2021, which year's net profit, turnover and net worth are we filling? You might be filing the form now, but remember that you're filing it in respect of FY 2021. In FY 2020, threshold conditions. The threshold conditions meaning the conditions which attracted CSR obligation to you related to the turnover, net worth and profit for the immediately preceding year. So we're talking about the figures for 1920. So please do understand that the details which are required to are details for 1920 as far as threshold applicability is concerned. The profit, which is the basis of a CSR obligation, is of course the average profit for last 3 years. Pradeep sir has very ably covered the BSR obligation. BRSR, as all of us understand, is mandatorily applicable for top 1000 companies from this financial year. And like I mentioned, I would reiterate that there's a lot of work, because you need to identify the value chain partners. You need to identify what is local community. You need to identify who are the stakeholders. You need to identify an appropriate GRM, because time and again, whenever BRSR reporting is to be done, it's about a grievance redressal mechanism. We have a whistleblower mechanism, but do you have a GRM? You might have a GRM for shareholders. That's the investors complaint mechanism run by SEBI. But mechanism whereby your customers can file a complaint? Do you have a mechanism whereby your workmen can file a complaint? Do you have a workman where anyone from the society, communities can file a complaint? So do you have channels of communication with various stakeholders, including the society, including the workers, including the value chain partners, including, let's say, your customers, who can address their grievances, if any, to the company, and how does the company redress them? What's the next level of the GRM? Every GRM has to have a mode of communication, a reporting of action taken, and the next level of appeal. If the one who is expressing the grievance is not happy with the decision, there has to be next level of appeal as well. So this entire mechanism has to be set by the company. When it comes to end of 22-23, and the company says whether there is a GRM applicable, let's say, for stakeholders to file any issue or make a complaint to the company. Question would be, did we have a system at all in place? So that's something that you need to keep alive during the whole of 22-23 to be able to report positively at the end of 22-23. You also need to identify the ESG related opportunities and risks by the company's business conduct. Business conduct would mean the company's business model. Does the company's business model throw any specific ESG challenges? And well, you also need to have a governance structure, because responsibility for BRSR is obviously on the board, but the board has to create a framework, a governance framework of who is the key person who would be responsible for discharging BRSR responsibilities. Similarly, designating personnel responsible for managing and dealing with various ESG aspects. All of this has to be done throughout the financial year to be able to report it in by way of the BRSR. I will not be spending time on CARO because that would take us into a whole lot of detail, but I would very quickly mention about some change in Schedule 3, which is applicable for the financial year just ended, And now that companies will be preparing the report for financial year 21-22, we need to understand that there are some additional disclosures required under Schedule 3. Among the disclosures required in Schedule 3, there are disclosures about shareholding of all promoters. Earlier, the disclosure was required only in case of shareholders holding more than 5%. Now, the disclosure is required in case of all shareholders. In addition, there are disclosures about loans and advances to promoters, directors, KMPs, and related parties, specifically for those which are repayable on demand or without specifying terms and conditions of repayment. There is an important disclosure about properties not held in the name of the company. Now, some companies have already become alerted on this, and please do understand the properties not held in name of the company does not actually relate to Benami properties. The idea of the government would have been to force a disclosure of Benami properties. Are there any properties which are not held in the name of the company? But actually, there might be many situations where the property held by the company is not currently in the name of the company. To give an example, if suppose a merger happened and there is a transfer undertaking which is merged into the company, now the process of mutation of the name of the transferee company will take quite some time. The property might still be lying in the name of the erstwhile company which is merged into your company now. That's obviously a case of property not held in the name of the company. There might be several situations where the property is held in the name of directors. For example, some licenses are taken in the name of individuals. The license might have been taken in the capacity of a trustee for the company. But if you technically ask, is it a property in the name of the company? That the answer would be no. So in case of any movable or immovable property not held in the company's own name, that is also a disclosure required by way of Schedule 3 disclosures now. Now, a very, very important disclosure about it, I think everyone would be at a loss as to how to figure it out, is a disclosure required about transactions with companies whose names have been struck off. Section 248 strike-off actions. Strike-off actions might have either been voluntary strike-off at the instance of the company or might have been a forced strike-off by the ROC itself. As everyone would recall, 3 years or 4 years earlier, we had a massive strike-off action by the MCA. Some 3.5 lakh names of companies were struck off. Recently, once again, one noticed in the newspaper, there has been a major notice by the MCA of some few hundreds of companies whose names are proposed to be struck off. Now, strike-off action might be taken by the MCA over a period of time. It might have been taken by the MCA, the ROCs, or might have been taken at the instance of the company itself. If the company has any transactions with such struck-off companies, what kind of transactions? Receivables, I think one can easily understand that if the company has money to receive from a company whose name is struck off, you need to notify that. Money payable to a company, you need to notify that as well. Other outstanding balances, you probably can notify that as well. Investment in securities, if you have invested in securities of a company whose name is struck off, you might need to notify that as well. But the major issue is shares held by a struck off company. That is to say, in your list of shareholders, if you have any company whose name has been struck off, you need to give a disclosure of that. If you think of a large company, list of shareholders of a large company would run in few lakhs. And out of these few lakhs, probably like a couple of lakhs, or let's say 1 lakh would be, or let's say 50,000. Even if you have 50,000 companies, out of let's say 10 lakh list of shareholders, you have 50,000 companies, corporate shareholders. Would you be able to create an algorithm whereby you scan through the list of all these 50,000 companies and identify whether these 50,000 companies are showing active status in ROC records? I think I can challenge, no one would probably have the capability of running through a list of 50,000 companies being a part of my list of members and have any mechanism, be it automated or semi-automated, other than completely manual process. Completely manual process checking through the status of 50,000 companies will take us some 500 days. So that's therefore impossibility. But technology does not permit us to currently check, the names of all the companies who are sitting as a part of my list of members. So this is one disclosure which is mandated for Schedule 3. We have noted there is a guidance note of the Institute of Chartered Accountants of India. The guidance note actually does not give a guidance on this question. It probably shocks the question. So I think people have taken a sort of convenient interpretation that if during the year, because after all you're reporting Schedule 3 is for a particular year, that during FY 21-22, if there were any shares which were held, that would mean one can actually disregard the opening balances of during the year if there were transactions in the shares of the company by any company whose name is struck off. But that also would be a major challenge, because how to track the list of companies whose names were struck off? Are we talking of names which were struck off during FY 21-22? Or are we talking about cumulative list of all companies whose names have been struck off? The intent of the MC is quite clear. MC is trying to do a data mining. I mean, by forcing companies to disclose shares held by struck off companies, MC is trying to gather a very valuable data as to how many shares in corporate India are held by companies whose names have been struck off. And I'm sure you understand what is the next step going to be. The next step would very conveniently be to ask all the shares to be shifted to IPF. But so as of now, the government is gathering data, and therefore their intent is quite clear that they would want the cumulative list of all companies whose names have been struck off to be compared with the register of members to find out how many companies there are in the list of members whose names have been struck off. But I think actually achieving this formidable task, I think it's an extreme challenge, I would say, but that's something which is applicable for FY 21-22, and therefore you're going to face this question very soon. If you haven't sort of faced it right away, you're going to face it very soon. So these were some of the Companies Act issues that I wanted to address today, and I would now move to the changes in LODR on related party transactions, because that was, as Pradeep sir mentioned, that is an important issue. And these are changes which obviously are applicable from 1st April 2022. 30th March, SEBI came with some clarifications. People were expecting some kind of relaxation, some kind of deferral of implementation, or sort of easing of the process. None of that happened. And the clarifications given by SEBI actually go very much with the intent of the changes, and therefore the seriousness on the part of the regulator is quite clear. So these are changes which already are applicable from April 2022, and I would lead you through the important changes. Number one, in the meaning of related parties. Number two, in the meaning of related party transactions. And number three, the changes as far as AGM shareholders approval is concerned. Whether you do it through a general meeting, you do it through a postal ballot, you do it in whatever way, but the manner in which shareholders approval will have to be obtained. So three very significant changes: change in definition of related parties, change in definition of related party transactions, and third, and I would say the most significant change, is the change as far as obtaining approval of shareholders is concerned. These are the three very significant changes. I'll talk about that, and thereafter I would be happy to discuss questions which Alka ji has sent, Sandeep ji also has been sending, and I think questions might pop up during the discussion as well. So please feel free to write your questions, and we'll be happy to interact with the queries. So first of all, change in the definition of related party. Definition of related parties changed to bring in new relationships, that is new related parties. Who are the new related parties? First of all entities forming, let's first of all try, looking at the change and then look at what is the aggregate position that appears after the change. The elements of definition of RP. By the way, I saw a question which Sandeep ji sent some time back saying, is regulation 23 in line with section 188? Is regulation 23 aligned with section 188? And I must quickly say absolutely no. There's absolutely no alignment between section 188 and regulation 23. Regulation 23 has taken a new trajectory altogether. Section 188 still remains what it was, with some changes over time, but section 188 is different. But SEBI has continued to make RPT provisions aligned with business scenarios. So I must say, when it comes to listed entities, much more than section 188, much more than section 177 by 4, and much more than section 188 is regulation 23. I would say if you have complied with regulation 23, you have practically complied with section 177, 188 both. So this is not just limited to RPTs. In fact, with most important corporate governance principles, be it independent directors, be it audit committee's role, be it the appointment or reappointment of independent directors, everywhere where there is an important question of corporate governance, SEBI has taken a far more stricter, stringent, dynamic role than the Companies Act. I go to the extent of even saying that it is time that MCA thought of exempting listed companies from Companies Act corporate governance provisions, because a parallel applicability of section 188 and regulation 23 has no meaning, because though there is no conflict, but if you're complying with regulation 23, you actually complied with section 188 as well. But to say that I have to comply with both is actually sounding redundant, because SEBI's regulations are far more stricter, far more comprehensive, and far more dynamic, but they have been living with the reality of the corporate world. So let's first of all look at the definition of RP, related party. Companies Act talks about only section 2 by 76. But when it comes to regulation 23, there are several elements. What are the elements? Number one, parties covered by section 2 by 76. The first, which is commonality between the Companies Act and regulation 23. Section 2 by 76 is captured in regulation 23 as well. Then comes all such persons or entities covered by the applicable accounting standard. Since we're talking about listed entities, the applicable accounting standard is Ind AS 24. So all persons or entities captured as related parties in terms of Ind AS 24. Ind AS 24 para 9 is the relevant para we're talking about. Para 9 has two parts. 9A talks about persons. 9B talks about entities. Please understand the jargon. In accounting standard jargon, the word person means natural person. The word entity means artificial entities. So 9A talks about persons, 9B talks about entities. And you need to look through the various clauses of 9A and 9B very thoroughly to understand who all are the related parties covered by Ind AS 24. That's part 2 of SEBI's definition. Part 3 of SEBI's definition is all such persons or entities who are treated as promoters or persons forming part of promoter group. Promoters and promoter group, irrespective of shareholding. Any person or entity which is forming a part of promoter or promoter group, irrespective of whether any shares are held by such promoter or promoter group entity, will still be taken as related party. This is different from how the definition earlier was, because earlier promoters and promoter group entities were captured as related parties only based on shareholding. Now shareholding has become completely irrelevant. So any person or entity forming part of promoter is one, and then persons or entities forming part of promoter group. Promoters and promoter group both are defined as per ICDR regulations. So you have to pick up the definition of promoter and promoter group from ICDR. ICDR takes you back to the meaning of control, which is defined in SAST regulations. Therefore, you're actually traveling from the LODR to ICDR, from ICDR to SAST, and identify who are the parties forming part of promoter and promoter group. When it comes to accounting standards, you're going to Ind AS 24 to find out which are the persons or entities having control or significant influence. And then for meaning of control, you're moving to Ind AS 110. And for the meaning of significant influence, once again, you're going to the accounting standard dealing with joint ventures, significant influence, etc. So you need to travel through multiple regulatory pieces to identify. I must say the most critical part of controlling RPTs is proper identification of RPs. The last few months of implementing RPTs, well, whatever little experience we've had, our view is quite clear that the task really is to identify RPs. If you identified related parties, you've done 75% of the task. Because once you identify related parties properly, then keeping track of transactions with these parties might be automated. But what is not automated is introspection or rummaging through the extremely complicated definitions coming from accounting standards and ICDR regulations to identify who are the related parties. So the third component of definition of RP is persons forming part of promoter or promoter group, irrespective of the shareholding. The fourth part of the definition is any shareholder who is beneficially entitled to 20% or more shareholding. This 20% will become 10% from FY23 onwards. As of now, 22-23, we're talking about 20% holding. 20% shareholding. Now, this is also once again irrespective of whether such shareholder is a promoter or promoter group entity. If a shareholder has 20% beneficial holding in the entity, we need to also understand what is the meaning of beneficial holding. Then the shareholder will be captured as related party, irrespective of the participation of the shareholder, either in control or in significant influence. That's the fourth element. And the fifth element is when it comes to the holding entity, we need to capture the related parties of each of the subsidiaries. That would mean for the holding entity, related parties of the holding entity, as well as related parties of the subsidiaries need to be taken as related parties. Then for the subsidiary, related parties of the company itself and related parties of fellow subsidiaries and related parties of the holding entity. So we are identifying not just the related parties of the entity in question, but related parties of the holding company in case of subsidiaries and fellow subsidiaries in case of subsidiaries, and the related parties of subsidiaries in case of holding companies. So there are as many as 5 elements of the definition itself. And I would once again cite our experience to say that this is something which is taking tremendous amount of time, tremendous amount of intellectual exercise in identifying related parties. So that's the very important change in the definition of related party. Now comes the change in definition of related party transaction. Thankfully, this change is effective from FY23. And I'm 100% sure Sandeepji will invite another workshop maybe to talk about this amendment because they're applicable from next year, Sandeepji. So I'm sure we'll have occasion to discuss this once again. But this important change is what is called purpose and effect of a transaction. So I'm sure all of you can identify if I make a list of related parties, are we doing a transaction with these related parties? Becomes a sort of automated question because we list out, let's say 40, 50, 60, 70 parties who by these 5 elements I talked about, they are taken as RPs. Next thing that the ERP system or whatever system the company is working on can identify if we have had any transaction with these 40, 50, 60, 70 entities. Now tell me, have you ever been able to envisage a list of unrelated parties? I can make a list of who all my friends are. Can I make a list of who all are not my friends? Can anyone ever profess to have the capability of making a list of who all are not my friends? Unless you say that everyone on earth is my friend, I am sure no one would ever be able to envisage a list of who all are not your friends. So now this purpose and effect test says that if you do a transaction with any party who is not a related party, they do a transaction with an unrelated party. But the purpose and effect of this transaction is to benefit a related party, then this transaction will also constitute an RPT. Purpose and effect. Purpose means what? Purpose means the intent of the transaction was to benefit a related party. And intent and effect both. Intent was to benefit a related party. The effect also ultimately is to benefit a related party. Intent and effect both are satisfied. Then the transaction, even if done with an unrelated party, will constitute a related party transaction. So what kind of transactions are we talking about? We are talking about transactions where the identity of a related party is masked. We are talking about an artificial masking. फेस मास्क ऐसा मास्क है, फेस मास्क में फिर भी चेहरा दिख जाता है, ये ऐसा मास्क है जिसमें चेहरा नहीं दिखता, माने समझिए पूरे फेस को कवर करने वाला मंकी कैप लगा रखा है किसी ने, मंकी कैप के पीछे जो चेहरा है दैट्स द चेहरा ऑफ ए रिलेटेड पार्टी. तो आप मंकी कैप को मत देखिए, मंकी कैप के पीछे वाले चेहरे को देखिए. सो बेसिकली व्हाट यू ट्राइंग, डोंट लुक एट द आइडेंटिटी ऑफ द पर्सन with whom you're doing a transaction, look at the identity of the actual beneficiary of this transaction. So we are basically talking about what? You have deliberately engineered or masqueraded, camouflaged the identity of the related party. You're trying to put a screen so that the identity of the related party is not visible, and you're doing a transaction with an unrelated party. अगर आपने ऐसा किया है, in that case, you cannot therefore escape from the regulatory net. Effective 1st April 2023, these transactions will also be treated as RPTs. This leads us to two questions. I'm saying we'll probably have a lot more questions, but we'll probably wait for a suitable opportunity. And I'll look forward to Sandeepji's invitation next time whenever he calls me to talk about this prior to 1st April 2023. Sandeepji is always so very receptive when it comes. I mean, मेरे को इतनी opportunity देते हैं, मेरे को मतलब I'm actually thankful to him. Now coming to Sandeepji, coming to the two questions at this juncture. Number one, if you're doing a transaction with an unrelated party, the purpose and effect of which is to benefit a related party, how would anyone come to know about these transactions? किसी ने जानबूझकर अपने चेहरे पर नकाब डाला है, एक नकाब को पोष ने अपने चेहरे को नकाब से ढका है. किसी को कैसे मालूम चलेगा नकाब के पीछे कौन है, पर्दे के पीछे कौन है, कैसे मालूम चलेगा? तो how would either the audit committee or the independent directors or the compliance professional ever identify who is behind the screen? That's first question. The person who actually has put the screen deliberately with a view to hide his identity, you obviously don't expect him to stand up and say that I am the person behind the screen. Otherwise, I mean, the whole purpose of putting the screen gets frustrated. So number one, implementation issue. And number two, are we saying that in 22-23, it's perfectly okay because SEBI has put the implementation date to 1st April 2023. Are we saying in FY 22-23, we are happy, we are free to design transactions such that the apparent party is an unrelated party, but the purpose and effect is very clearly to benefit a related party? Mane subterfuges, camouflage transactions, indirect transactions, are sort of oblique or tangent transactions which are so engineered so as to benefit a related party. Are we saying it's perfectly okay to do it in we can continue to do in FY 22-23 because the regulation is applicable only from 1st April 2023. The second question is very easy to handle. The intent of regulators is very clearly to say that you don't trust on subterfuges, don't trust on camouflages. If you're thinking you can dodge the regulation by putting unrelated transaction, SEBI will be after you from 1st April 2023. It's putting you to a sort of advance notice that the approach will always be to remove the screen, to remove the parda, to remove the mask, and look at who is the naqab post behind the naqab. That's the regulator's intent. So you cannot do it in FY 22-23 either. You couldn't have done it in the past. You cannot do it in this financial year. And sure enough, officially, you will anyway be reporting transactions based on purpose and effect from FY 23-24. Now comes the implementation question. How are you going to implement it? How would you identify transactions which are deliberately masked? So to my mind, I think the only way I can think, it will probably develop more thinking during the course of the year. But what is my current thinking is that we'll probably expect the audit committee to ask all related parties to sign a sort of annual declaration that during the financial year, they are not aware or they are not responsible for having conducted any transaction, the purpose and effect of which is to benefit them. Somebody who has done it deliberately may still sign on a dotted line to say that I have not done it, but that would be deceitful. And when people are made to sign on dotted line, the impact is very different. All fellow professionals would agree with me that when you ask people to sign on the dotted line, people become extremely cautious. So even the sheer impact of signing on this declaration that I have not been responsible and I'm not aware of any transactions, the purpose and effect of which is to benefit me, that will lead to much better control on RPTs. This is of course applicable from the next financial year. Now the very, very important point on which I wanted to speak, I'm stressing on this because this is the single most important change, apart of course from the change in definition of RPs, is approval of shareholders. Two major changes. Number one, the threshold. Earlier threshold was 10% of consolidated turnover. Companies Act had earlier a monetary limit and also had 10% of turnover. Later on, the monetary limit was dropped, so we only had 10% of turnover. SEBI will all the time talking about consolidated turnover. Companies Act was talking about all the time turnover. When it comes to the changed definition, which is applicable from 1st April 2022, so it's already applicable 5 days ago, 1st April 2022, this change has already taken place. The definition is now what? Definition now says threshold is 10% of consolidated turnover or rupees 1000 crores, whichever is less. If you, for the sake of completeness, and I'm repeating that, and each of these words are extremely significant, so I'm hoping the professionals participating today can take a very serious note of the way the annual, the shareholders approval requirement is structured. Transaction or transactions, irrespective of the nature of transactions. Transaction or transactions done during a financial year. What is a financial year here? We're talking about FY 22-23, so transaction or transactions done with a related party during financial year 22-23. We aggregate them together and then compare this aggregate with the consolidated turnover for FY 21-22, either 10% of that or rupees 1000 crores, whichever is lower, is exceeded by the transaction or transactions done during FY 22-23. In that case, you need prior shareholders approval. Earlier, Regulation 23 was not talking about prior approval. So two things have changed. Number one, threshold is now absolute threshold as well. So 1000 crores or 10% of consolidated turnover, CFS turnover. And the approval requirement is now prior approval. Earlier, we always had a possibility of taking a post facto approval. Now try to see the implement. Now I also refer to the 30th March clarification. By the way, the view that we had expressed earlier, and many of you might have seen our FAQs or our write-ups on this issue, we have consistently said that this is applicable to past contracts as well. If contracts have been done before 1st April 2022, the contracts have not come for shareholders approval, and these past contracts give rise to transactions in FY 22-23, then the transactions in FY 22-23 will still require approval. This was a view that we had expressed, and SEBI by the 30th March clarification has actually taken the same view. So let me explain what we're trying to say. Supposing you've done a long-term contract, let's say in year 2019 you signed a long-term contract with a related party. Say in this case the related party is a non-wholly owned subsidiary. It's a subsidiary which is not wholly owned. You signed a contract. It's a long-term contract signed in 2019. Contract was signed in 2019. At that stage, the 10% limit of consolidated turnover was not exceeded, and therefore the contract never came to shareholders. This contract, however, is a long-term. Let's say the tenure of the contract is 5 years. Let's say 5-year material purchase agreement. Let's say 5-year supply agreement, 5 years power purchase agreement, 5 years whatever, take or leave agreement. You could probably take or pay agreement or whatever the agreement which is typically having a long tenure. So in 2019 we signed the contract. Transactions continue to take place under that contract. Now we come to FY 22-23, we find that the limit of 1000 crores is getting exceeded. If we aggregate all transactions with the same related party, the turnover limit is getting exceeded. So would we take approval for transaction or transactions in FY 22-23 even for a contract which has already been signed? Our answer was yes. SEBI is also saying yes. Assume for a minute that shareholders say no. Say shareholders have turned down the approval. Then what happens? We have a contract already, but shareholders, इसमें shareholder माई बाप है. आपने shareholders के सामने प्लेस किया कि भाई ऐसे contract हमने कर रखा है, तुम लोग इसको approve करोगे तो आगे बढ़ेंगे, नहीं approve करोगे तो वहीं बंद कर देंगे. So even if the contract is a long-term contract, whatever might be the consequences of termination of contract, the contract goes for shareholders for basis the transactions in FY 22-23. If it's rejected by shareholders, the company will be forced to terminate the transaction. So now the question is, at what stage do we take approval? And SEBI also clarifies the same point, that the moment your aggregate value of transactions reaches 1000 crores, before that you should have gone for shareholders approval. It's in this light that you would have seen a lot of companies have already gone for shareholders approval. A lot of companies in the month of February and March have gone for postal ballots to take shareholders approval already. Sensible companies which foresaw that, I mean, who knows when will the turnover limit get crossed? Business exigencies might demand that there might be transactions with a related party. Business will not stop for compliance officers' work. Because if you impact business, you will come under a heavy, critique within the entity. So therefore, sensible companies have gone for approval already based on estimates of turnover or estimates of transactions with related party by way of postal ballots, which is what SEBI also expects, that before you hit the 1000 crore ceiling, you should have taken approval. Therefore, please do ensure that in the first opportunity of taking approval, the approvals are taken at the, you take it by general meeting, you take it by way of a postal ballot. General meeting is still several months away. And if you think transactions are going to cross the limit, you can take approval by way of postal ballot anytime before your aggregate value hits 1000 crores. Assuming that the limit is already exceeded, you have not taken shareholders approval, what would be the consequence? Well, I can either say, well, the consequence could be that whatever the related parties which have benefited would probably be liable for disgorgement of profits or benefits. Compliance officer and those who are responsible will probably come under penal consequences. My fellow professionals would quite often be the compliance professionals. They might be the CFOs or CSs of companies. Please do not risk an LODR violation. Don't look at the monetary impact. 5 lakh lage ki 10 lakh lage. Please understand it's a blot on a career. For all time to come, you'll probably be required to disclose somewhere that you were fined by SEBI or penalized by SEBI. Please don't have that record at all. It's not at all, good to carry this luggage of SEBI adverse action as a part of your career. So please ensure that you're not doing any kotahi, any lackadaisical approach in implementation of RPT. So please ensure that you taken timely approvals. Next and final point is, while taking approval from shareholders, is it a generalized approval or you place details and data about the contract? SEBI, the 30th March circular also says that appropriate disclosures to shareholders is the basis for an informed shareholder decision. So we've seen some entities making extremely vague explanatory statements to special resolutions. Some companies have gone to the extent of saying कि मैं 1000 crore से ऊपर करूंगा, कितना करूंगा नहीं बताऊंगा आपको, क्या transaction करूंगा नहीं बताऊंगा, कुछ भी नहीं बताऊंगा, आप खाली approval दे दीजिए. And shareholders have happily given approval as well. But SEBI is surely not happy with those kinds of explanatory statements. So SEBI is very clearly saying that full details of transactions proposed, similar to details which are placed before the audit committee, should be given to general meeting as well. And it's on the basis of these disclosures that you obtain the shareholders' approval. So these were the significant changes. I must also very quickly mention that there is a revised format of half-yearly disclosure. कई बार तो क्या होता है कि लॉ के ऊपर फॉर्म हावी हो जाता है. अब CSR में आप देखें, CSR लॉ कुछ बोलता है, फॉर्म कुछ और बोलता है. और वो जो है ना कि कानून के ऊपर फॉर्म हावी हो गया, लॉ तो कुछ और है, फॉर्म उसके ऊपर आके बैठ जाता है. तो आई थिंक LODR में something similar. Pradeep sir is extremely receptive. SEBI itself is very receptive, and we definitely are meaning to take it up with Pradeep sir and other people in SEBI that ये जो अभी फॉर्म आया है for half-yearly disclosure, I think the form is highly flawed form. इस बहुत सारे flaws है. सबसे पहला flaw तो ये है कि it's expecting all details of all RPTs irrespective of value. The SEBI has to be talking from material disclosures. You're talking about disclosures in public domain. 1000 रुपए का transaction, 10,000 का transaction, 5 lakh का transaction. What relevance does it carry? If I prepare a huge bunch of disclosures which is like running in hundreds of entries, the significant information is buried in redundant information. The whole idea of reporting is to avoid redundancy. Because the more of redundancy we have, significant items get listed. It's almost like throwing the baby with bath water. So number one, there has to be a de minimis value. For any reporting, there has to be minimal value. That's part one. Part two, the form seems to suggest that all transactions of subsidiaries also need to be reported. This is very clearly a flaw. I mean, we will definitely want to discuss with SEBI if they had a thought process. There are two issues. Number one, transactions done by subsidiaries with their own related parties, where the holding entity is not even a party. Why would the holding entity at all be concerned with those transactions? Subsidiary has done transactions with its own related parties. The transactions come to audit committee of the holding entity only if they cross a limit of significant transactions. There's a concept of material transactions. There's a concept of significant transaction. Done at subsidiary level, a transaction is considered to be significant only if the transaction is crossing a limit of 10% of TFS turnover. From next year, it becomes 10% of standalone turnover. But for FY 22-23, it's 10% of the consolidated turnover. So transaction does not even come to the audit committee unless it has crossed the significant threshold. Are we saying that what is not even reporting to audit committee, because it's not required to be reported, will be reported to public? It is counterintuitive to say that what is not even reported to audit committee of the holding entity will be reported by the holding entity to the public. It's a completely counterintuitive thought. So our interpretation is that it's only those transactions which are significant which need to be reported. That's our reading. However, the form is certainly vague on that, and wherever the form is vague, the stock exchanges, the way they are trained, they say, I mean, they take the most stringent interpretation. I am told by several companies that the stock exchanges have already taken a view that the form is already applicable for March 22 as well. But while SEBI clearly mentioned that the revised form will be applicable from September 22, stock exchanges, however, have taken a view that it's already applicable for March 22 also. Now, of course, the question is, let's say we use the form for March 22. Will we use the law that existed till March 22, or will we look at the law as will exist from 1st April 2022? Sure enough, we cannot drag the applicability date of the law to the previous year. So even if we are using the format for reporting, we are looking at reporting based on the law that existed till 31st March 2020. These are, I mean, issues that one has to take up with SEBI. There's no point in breaking up these issues with stock exchanges. I think the right way will be to address these questions to SEBI, and I completely trust what Pradeep Ramakrishnan had mentioned, that SEBI is extremely receptive. They will be willing to listen. So these were some of the thoughts about, I just add a couple of points. Number one, material modifications. The RPT policy, if you are talking from a compliance perspective, there's a lot of work to do, and the work to do includes amending the RPT policy. Amendments to RPT policy will include revised definition of RP, as also definition of material modifications. What is material modification? That's to be defined by the audit committee. To the RPT policy, you need to define what will be material modifications. So material modifications in a material contract will require shareholders' approval. Immaterial modifications in a material contract will not require shareholders' approval. Immaterial modifications in immaterial contract, the question does not arise. And if you're making material modification to an immaterial contract, that also does not require shareholders' approval. So basically, it's to summarize, if there's a material modification in a material contract or material transaction, it goes for shareholders' approval. What exactly is material has to be defined by audit committee by way of RPT policy. In our view, there are several parameters one can lay down in defining the material modifications. One can, for example, say, if the value of the contract changes by a certain percentage, tenure of the contract changes by a certain percentage, if what was earlier arm's length ceases to be arm's length, if the ranking of the company in terms of priorities moves down or moves up, if the security nature, the exposure was earlier secured, now it becomes unsecured, waiver of security interests, subordination of rights, could be instances of matters where one could take the modification as having a material impact. Sandeep ji was kind enough to allow me roughly about, I think I've taken almost like 1 hour. And I know there are many questions which have already been flashed on the chat, or maybe on the WhatsApp message that Sandeep ji has been sending. I don't know if there are other questions which have come on the chat as well, but whatever be the right way to deal with the questions, maybe if you want me to run through the questions which Sandeep ji has been sending on WhatsApp, Alka ji also sent some questions earlier, I can do that. Or is there a better way we can deal with those questions? So there are some questions which just came from Sandeep ji. Number one, how will HVDLE companies which are wholly owned subsidiaries pass resolution by shareholders of material related party transactions, and the related party will not be able to vote irrespective of the fact that it's not a party to the transaction? This is a question. It's actually for HVDLEs, compliance with RPT provisions, compliance with regulation 23 in FY 22-23 is on a comply or explain basis. For high value debt listed entities, compliance with RPT provisions is on a comply or explain basis. We indeed had pointed this out to SEBI, and the response we got from SEBI was that since it's anyway Corex provisions, let's see it in FY 22-23, and if need be, we'll carry out necessary changes. But the problem that the queries has highlighted is a real problem, because if there is a material contract by a subsidiary and the subsidiary wants to take shareholders approval, the only shareholder is the holding entity, and the holding entity, or there might be two shareholders, let's say two holding or two joint venture partners. Both of these will be related parties, and therefore they will be restrained from approving the contract. So the question is, if we talk about regulation 23 approval from shareholders to the exclusion of related parties, we are left with no shareholder at all, and therefore it becomes a case of impossibility. I did mention that we took this matter to SEBI. As of now, we've been told that let's wait, because this is so far Corex. You can therefore say that there is an impossibility of approval because there are no unrelated shareholders at all, and we hope that SEBI will take a little pragmatic view of the situation. Another question, which is regulation 16(1)(b) Roman 5 capital D, states that any other pecuniary transaction relationship with the listed entity, holding entity, blah blah blah. It does not specify the time during which an ID need to check for this clause. Can you please throw light? I have not been able to understand this question though. Amounting to 2% or more of the gross turnover. I think it's basically on the independence of independent director. It's probably on the conditions of independence, and it's saying the holding is blah blah at 2% or more. It does not specify the time during which an ID need to check. IDs have to reaffirm their independence every year. Every financial year, IDs have to reaffirm that there is no change in circumstances affecting their independence. For example, Companies Act also talk about material pecuniary interest. So if subsequent to their appointment, the IDs have landed into a situation where their pecuniary interest becomes material, then they should bring this cessation of independence to the notice of the board of directors immediately. And based on that, the board of directors can then take a view. The NRC and the board of directors can take a view if the appointment of the independent director continues. Because if there's a compromise in the independence of the independent director, then I think the right course for the independent director would be either he takes a course correction and plugs that region for which the independence was compromised, of course by bringing it to the notice of NRC, or he tenders his resignation. There is a question about ESOP audit for secretarial auditors. So ESOP audit is one of the additional certificates to be given by a secretarial auditor with effect from this financial year. And question is, what is the scope? I think it's a very interesting question. You are actually commenting on two things. Number one, the ESOP the SBEB regulations, adherence to SBEB regulations, and number two, you're commenting on the adherence to the ESOP scheme. So basically, two things are to be checked: the provisions of the SBEB regulations, to what extent are the provisions getting complied with, and number two, the provisions of the the ESOP. It could be ESOP or any other form of employee benefit, the scheme approved by shareholders. So the basis of checking would be number one, the regulations, number two, the ESOP scheme framed by the company, number three, the shareholders resolution, And number 4, the resolutions passed by the NRC pursuant to the scheme and the resolutions. So whether the actual execution of the share-based employee benefit plan has kept in line with the provisions of the regulations and the shareholders approval. There are complicated provisions of SBB regulations as well, and therefore this is quite a comprehensive task, I would say. And whoever does, the secretarial auditor has to therefore prepare a comprehensive checklist of the applicable regulations. So the scope will actually be whatever are the provisions of the SBB regulations and the shareholders resolution, and then check their adherence in the actual implementation. And that's what I would say is the scope of the audit. I talked about regulation 23 and section 188. There is no alignment between the two. There is a question: if an unlisted subsidiary company avails an unsecured loan from its listed holding company, then is it a related party transaction from the point of view of the subsidiary company? Transactions between a holding entity and its wholly owned subsidiary. Transactions between a holding company and its wholly owned subsidiary are disregarded. There is no RPT between a holding entity and a wholly owned subsidiary. But if it is a non-wholly owned company, then a transaction between the holding company's transaction with a related party. Likewise, transaction done by the subsidiary with the holding entity is also also a related party transaction. So in the situation of wholly owned relationship, there is no transaction, there is no issue at all. In case of non-wholly owned entities, transactions will be taken as RPTs from both the entities' point of view. There is a question about reporting of transactions with MSMEs. The question is if there were any dues of more than 45 days as on April, but subsequently when you're supposed to file it, the amount is cleared. Are you still required to report it? To my mind, the answer would be yes, but you can add a comment that subsequently the due has been settled, has been taken care of. BRSR, I think the questions were ably answered by Pradeep sir already. If there was a question to say that if BRSR is once applicable because of market cap and subsequently the market cap declines, you were among the top 1000 companies, subsequently you cease to be top 1000 companies, are you still required to comply with BRSR? The answer is very clearly yes. Ms. SEBI has very clearly mentioned that if any of the LODR provisions get attracted because of market cap, they will continue to apply even if the market cap declines. So that's coming very clearly. There's a very interesting question about section 42 special resolution in case of private companies issuing non-convertible debentures. I'll give a quick perspective for everyone to appreciate the question. This question is very tricky and very interesting question. Section 42 requires an issuance of non-convertible debentures to be backed by special resolution, section 42-71 combination. And then we go to section 180, which says that a limit of borrowing for any company without shareholders resolution is the paid up capital and free reserves. If the board of directors want to exceed the paid up capital and free reserves, they have to go to shareholders and take a special resolution. Now, section 42 rules were subsequently amended to permit, bonds to become more popular, to say that if the issuance of bonds or debentures is within the limit approved by shareholders in terms of section 180, subsection 1, clause C, then you do not need a separate special resolution for bond issuance. Now, the question is, if my company is a private company, section 181C approval is not applicable in case of private companies. I am a private company, therefore I did not need a shareholder special resolution at all. Will the special resolution for issuing bonds under section 42-71 will be still needed because I don't have a shareholder resolution at all? Or do I say every bond issuance or once in a year, the company has to continue to pass special resolutions? I must say that my views here are slightly differing from the views of my colleagues. We discussed this issue recently and we found that there is an internal gap in our own views. I would, however, say that a private company is allowed to borrow beyond the limit of net worth without any members' resolution. And therefore, what is the limit for a private company? There's no limit for a private company. The limit is what is set by the board of directors. If there is no limit for a private company at all to borrow, one can argue that even the special resolution for issuing bonds. The idea basically is that issuance of bonds, as long as it's happening within borrowing powers, should not be calling for a special resolution, should not be calling for a separate sanction from shareholders. If shareholders have permitted the board of directors to borrow by alternative means, and the company instead of choosing alternative means is choosing, let's say, bond issuance, why would the shareholders' intervention at all be required? So going by this principle, if the board of directors could have borrowed, let's say, by non-capital market sources, and instead of non-capital market sources, they're moving to capital markets for borrowing, I don't see any reason. So in my view, a private company may issue bonds without having to take a special resolution in terms of section 42, because section 180 itself is not applicable to private companies. These were the questions that Sandeep ji has forwarded. Alka ji also had forwarded some questions earlier. Some questions were on the CSR 2 format, which I dealt with while speaking. Now I would ask Sandeep ji if there are any further questions that you have on the chat board right now, or participants might like to post any further questions while they were participating. Sandeep ji, Alka ji, any further questions you would like me to comment upon?
Yes, sir. Yes, sir. Vinod sir, you have mentioned that definition of RPT is changing every time. Can we assume now that definition of RPT is in line with Companies Act, its rules, LODR?
It's then not at all. Definition of RPTs in LODR is not at all in line with Companies Act. माने कंपनी एक्ट कहीं छूट गया, जो आरपीटी की जो रेस है इसमें सेबी कहीं आगे बढ़ चुका और कंपनी एक्ट बहुत पीछे रह गया. तो कंपनी एक्ट के साथ तो अलाइनमेंट पॉसिबल ही नहीं है.
प्रदीप सर का साथ में है, इसलिए मेरा ये क्वेश्चन था आपसे और प्रदीप सर से कि क्या एलओडीआर और कंपनीज एक्ट में आरपीटी का डेफिनेशन अपनी लाइन लाने का सोच रहे हैं?
आई थिंक द ओनली वे कुड बी कंपनीज एक्ट कुड से दैट व्हेन इट कम्स टू लिस्टेड कंपनीज लेट सेबी डिफाइन RPTs. Like, let's say for public issues, earlier, Sandeep, you would recall that for earlier public issues, prospectus, etc., were all governed by Companies Act as also by SEBI. Later on, Companies Act took the view that when it comes to listed entities, public issue requirements, disclosure in prospectus, etc., all of these will be governed by SEBI. So, Companies Act has become dormant when it comes to public issues by companies. Likewise, when it comes to something like RPTs, independent directors, audit committee functions, board functions, is significant corporate governance principles where SEBI has its own viewpoints. There's a very good ground for MCA to say, Bhaiya, I am relying on SEBI. SEBI jo listed companies ke requirement. Who will understand better than SEBI? SEBI is the body dealing with listed entities. Therefore, let MCA trust SEBI and say, मैं आप पे छोड़ता हूँ, आप जैसे डील करो वैसे करो, and therefore I take a background, I take a back seat, and you continue to drive the corporate governance car the way you want to drive it. Parallel applicability of section 188 as also regulation 23 is of no relevance actually.
Sir, you also touched upon the additional disclosure of keeping transparent in our annual report. And you have also mentioned, sir, that disclosure for transaction with a company which has been taken off. Disclosure about the shares held by the taken off company, sir. So my question is that if a company shareholder has been taken off, can company apply to NCLT tribunal for the reduction of capital on the basis of its shareholder strike off?
So Sandeep ji, section 66 lists out the condition under which a proceeding for reduction of capital can be done. The company's name, the shareholder's name has been struck off is not one of the conditions under section 66. Therefore, to my mind, reduction of capital in terms of section 66 is surely not possible. However, section 236 squeeze out, that is to my mind still possible. Minority squeeze out, that would mean if 90% of the shareholders agree to, or 90% of shareholders are, let's say, controlled by the promoter or promoters, then the 90% holder may squeeze out the remaining 10%, and that remaining 10% may include companies whose names are struck off as well. The only necessity would be that for 1 year you have to keep money in a separate account. If a claimant comes, fair enough, you pay the money. Claimant doesn't come, just get the shares transferred in name of the promoters. IEPF as of now is not applicable to section 236. So I think one can act under section 236. Sandeep ji.
Sir, Pradeep sir, and you have already captured all the questions of the members, sir, and we are very much thankful, sir. And Pradeep sir also mentioned the very good mentioning that disclosure by the RP, that whether the plan has been approved by the company or not, whether any company has been taken off or not. Pradeep ji also mentioned that Pradeep ji is also always available for us. We know, whenever we approach to SEBI and whenever we approach to Pradeep sir, he is always available for us. And Pradeep sir mentioned and suggested that we should come up with a guidance note for this. So we are working on it, sir. Pradeep sir. So sir, we on behalf of ICSI and all the members are very much thankful to both of you, sir, Pradeep sir and Vinod sir. And you both have transformed and the amendments, sir, and the manner and the practical ideas from both of you, sir. We all ICSI member has been benefited, sir. Now I will formally propose a vote of thanks to our esteemed speaker, both of you, sir, Vinod sir and Pradeep sir, for sparing your valuable time, for sparing your valuable thoughts, for giving us the insights of the amendments with your practical approach, sir. Now I would like to request our ICSI team to please display the Shahid Ki Beti certificate to Pradeep sir first and then Vinod sir first. ICSI team, please display the Shahid Ki Beti certificate to Pradeep sir. Alka madam, yes. Pradeep sir perhaps left. Yeah, then for a Shahid Ki Beti certificate for Vinod sir also. Alka madam, Shahid Ki Beti certificate for Vinod sir.
Thank you very much, Sandeep ji. Thank you very much, ICSI.
Yeah. Thank you, Vinod sir and Pradeep sir once again, and thank you all our esteemed members who has participated today. Thank you very much. Thank you, sir.